Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Bashar Al-Assad flees Syria to Moscow, ending his family's 50-year grip on the country as rebel forces take control of key cities. Meanwhile, Israel moves troops into Syrian territory and the US strikes dozens of ISIS targets. South Korean stocks sell off as pressure mounts on President Yoon to resign. European futures edge lower amid the global geopolitical turmoil. And President-elect Donald Trump says he has no plans to replace Fed Chair Jerome Powell when he takes office next month.
In the meantime, a quick check on these markets. Risk assets kind of pointing to the downside. When you look at your stock 50 futures down by 0.2%. The FTSE 100 outperforming, but it is flat. To me, I thought was interesting is the China store. We are seeing weakness in the Chinese yuan. Inflation data coming in weaker than expected. 728 on that currency pair. And, of course, one eye on the Middle East, just shy of the 72 handle when it comes to Brent crude. The countdown to the opening trade starts right now.
Monday the 9th, good morning. Sergio Amotti, UBS's Sergio Amotti, telling Bloomberg this morning that tariffs and geopolitics can rattle markets in 2025. Forget 2025, let's talk about 2024. Last week it was all about France. Last week was all about South Korea. We can now add Syria to the list of surprising and shocking geopolitical events. The question is, are these events going to upend markets? Syria is a really interesting one because it spreads out very quickly into the rest of the Middle East and potentially could impact Europe as well.
Yeah, we're already seeing that to some degree, Guy. And vacuum seems to be the word that stands out pretty loudly when you're reading a lot of the coverage this morning. A power vacuum. Where does this go? How violent is the process of getting to any political process in Syria? From the HTS, the SDF, the SNA, we've got acronyms aplenty, rebel groups aplenty, united up to this point by their dislike for Bashar al-Assad. What unites them, if anything, now as they try to craft a future for the Syrian people? We've seen Israeli forces crossing into Syria. We've seen the US hitting more than 70 ISIS targets. They are worried that ISIS might try to take advantage of the power vacuum in the mix. And meanwhile, President-elect Trump says this is not our fight.
It's a really interesting bifurcation between what Trump is doing and what the Biden take actually is. And you mentioned those strikes. But to me, the fact that this is really a function of Iran fighting really two fronts and several others in other parts of the Middle East, Russia trying to deal with their resources going to the war in Ukraine, and that really coming to a head in Syria when it came time to rely on those allies. Bashar al-Assad couldn't.
Turkey coming out of this potentially very strong. That's interesting in terms of the way that the region is going to shake out as well and what authority power Erdogan has on the back of this. I think it'll be really interesting to watch. I think we also need to remember from a European point of view, Syria was really at the genesis of the migration crisis that Europe had to deal with a few years back. And you do wonder whether or not there is a repeat potential here or a reversal potential here, or how this is going to shape European politics as well, because Syria, in so many ways, has been pivotal to that over the last few years.
I mean, there are Syrian refugees in Turkey, many of them, and there was a lot of European money went to Turkey to make that happen, to get them to stay there instead of coming to Europe, and that was more than a decade ago now. If this went well in Syria, could we see those people being able to go back? But, of course, it's much too early to make that kind of call.
Let's talk about what else we're watching as well. South Korea, absolutely fascinating. So President Yoon escaping impeachment over the weekend. What happens next? How do his allies maybe generate some sort of exit for him that is relatively peaceful? Obviously, we're still watching the fallout from his declaration of martial law. You're starting to see that really rippling into South Korean assets. You've got the won down pretty sharply. You've got the Kospi down pretty sharply. You've got the smaller mid-cap index down pretty sharply. That's what we're watching very carefully in terms of the read across into markets. Romania, also fascinating. People had already started voting in the second round of the Romanian presidential election, and then the Constitutional Court cancels the first round. So we're now looking potentially at another rerun in January. The Romanians don't know whether they're coming or going at this point, and markets are kind of very cautious on that, and you can see that being reflected in the Romanian leu, which has bounced quite strongly. Does that reverse? We don't know yet.
And the concerns, of course, coming as a function of what kind of Russian intervention there may be in that voting system as well. At the same time, Anna, that it comes up as issues in Moldova, issues in Georgia as well in terms of EU ascension. And this is really where I think the Trump administration makes a lot of sense here when it comes to what the ripple effects are, not just for Romania, but for other maybe countries around the world.
Yeah, absolutely. And on that Romanian story, I mean, it's so fascinating. This is the first time that a Western court has intervened to overturn the result of an election because of fear of meddling from Russia. And this, as you say, this is important because of what it means for the Russia relationship, important for these big tech names as well, from TikTok to Meta. You know, there's going to be increased scrutiny as a result of this.
Who's the president of the United States?
Well, it is President Biden at the moment, but, you know, in 6 weeks. Well, I think it's crucial, though, in terms of who can actually strike right now, who is representing the United States in terms of strikes in Syria, in terms of the political negotiations with, say, South Korea, Romania, and whatever. It is still President Biden. I think that's very clear in that even though Donald Trump, the president-elect, tweeted or Trump socialed or whatever the term is posted. Thank you. Thank you for educating me on social media, of all people. But posted about not getting involved. The United States is getting involved right now in terms of those strikes that you pointed out.
Yeah, absolutely. So there is that activity taking place. But to your point, Guy, a lot of the headlines coming out of Paris over the weekend were about President Trump being there with world leaders to celebrate the reopening of Notre Dame. Yeah, and he had a meeting with President Macron.
Yeah, like it felt like a state visit, which is the weird thing. And it does seem as if he is setting the agenda when it comes to what's happening in markets right now. Look at what is happening with crypto. Look at what is happening with the story around equity markets more broadly. It feels like he's setting the agenda in terms of what's happening on so many areas right now. So of course, President Biden is still president. But as somebody, I was reading a journal piece earlier talking about this is the lamest of lame duck presidencies that you've seen in quite some time.
It's a fair one. And to Anna's point in Paris, the fact that I think he made a statement, which I thought was or a comment saying that the world is a crazy place right now. And we're going to try to find our way around it or something along those lines. I thought that was quite interesting coming from him, standing right next to, by the way, Vladimir Zelensky when he said it.
Let's talk about what we've got coming up in the rest of the show. We've got this all covered for you. Paul Donovan, UBS Global Wealth Management Chief Economist, is going to be joining us. We've, of course, got US CPI this week, which is something to watch, plus an ECB meeting, which we're going to watch very, very carefully as well. Fawaz Gerges, LSE Professor of International Relations, is going to be joining us to talk about the collapse of the Assad regime and what that means for Europe and for the world. Marija Veitmane, State Street Global Markets Head of Equity Research, joining us. Traditionally, she has been long cash and long US tech. Does that trade still work? And Eduardo Lecubarri, JP Morgan Global Head of Small and Mid-Cap Equity Strategy, is going to be joining us later. Take a look at the gap between the performance of US small caps and European small caps. It is epic right now. We'll talk about that a little bit later, Kriti.
Well, throughout the rest of the week, plenty to watch as well. We're, of course, going to be monitoring the geopolitics, what happens out of Syria, of course. We're also on watch, by the way, for who Emmanuel Macron names as his new prime minister and what the new steps are there, not to mention things going on in other parts of Europe, including the Eurogroup finance ministers. They are meeting today. I believe Rachel Reeves is due to attend as well. That all happening today. Tomorrow, though, a Bloomberg event that we want to flag to our audience, Women, Money and Power. We, of course, will be broadcasting live from the event as well. In the lead up to it, we've got an all-star lineup. That's something that we'll, of course, talk about later in the show, but it's a show you do not want to miss. On Wednesday and Thursday, I think that's really where the markets start to kick in, perhaps a little bit more. China's policy meeting, plus that U.S. inflation data. Do we care about the jobs number from Friday? That, of course, blowout number, but does it make up for the month before? Maybe none of it matters in the face of the U.S. data. And then, of course, the ECB rate decision coming in on Thursday. We've got plenty of market moves, but I feel like kind of skewed to the back half.
Yeah, we've got something in every geography, haven't we? We've got US CPI, we've got an ECB rate decision, and we've got the Chinese Work Council meetings taking place. So, you know, every geography covered in terms of things that could move markets. Maybe none of them will. Maybe all of them will. We'll have to wait and see.
The payrolls didn't deliver very much at the back end of last week. Basically just confirmed a 25-bip cut coming from the Fed. But what happens next, I think, is going to be really interesting. Does the CPI change that narrative in any shape or form? Is a pause now front and centre for the beginning of next year? The ECB, 50's off the table, it seems, which in some ways is a surprise to us, given the data that we're seeing right now, which just gets worse and worse and worse. So it's going to be fascinating. The Works Council thing, I live in expectation.
Yes, we seem to always be living in expectation of something that's going to deliver enough fiscal stimulus to get Chinese consumers spending. We had that CPI print out just overnight, didn't we? Yeah. Out of China, it came in, it slowed once again, came in below estimate. Yeah. PPI was, 26 months and counting that we have drops in PPI, deflation in PPI coming out of Chinese factories.
And that's showing up in the weakness of the Chinese yuan this morning. If you look at the biggest currency moves, whereas I feel like you're seeing the dollar, the euro, the pound, a little bit kind of shrugging their shoulders, whatever the currency equivalent of that, fairly flat. It's the Chinese yuan where you are seeing most of that volatility. So still very sensitive to that data at a time when I don't think inflation is really the story in China anyway.
Except that it highlights the fact that what has been done thus far has not delivered.
Yeah.
So what it implies is that if you want to get these numbers moving, you're going to have to do a lot more heavy lifting. That would certainly seem to be one read of this data. It kind of just begins to capture some of the period in which we've started to see talk of stimulus coming in.
Yeah. OK, let's return to our top story this morning. Syrian President Bashar Al-Assad's government has fallen after a stunning territorial advance by opposition groups over the past few days. Joining us now, Bloomberg's Sam Dagger, who is in the region for us. Sam, very good to have you with us. From the region, tell us a little bit more about the power vacuum that has been created and people's expectations as to what happens next.
Absolutely. I mean, good to be with you. I'm going to start basically to what's happening on the ground. I mean, it was really incredible. I mean, just to see Syrians celebrating both inside Syria. Yes, there were scenes of chaos, some looting, but in general, I mean, Syrians have been rejoicing. I mean, we have to remember. I know the outside world is now focused on what comes next, but we have to remember people are still. I mean, Syrians are still getting their bearings. This is a family that's ruled over half a century. I mean, the dad took over in a military coup in 1970. He built one of the most brutal dictatorships in the world, underpinned by this cult of personality, repression, and sort of unspeakable violence. And then, I mean, on paper, Syria is a republic, but for all intents and purposes, it is a monarchy. I mean, he handed over power to his son in the year 2000. Then a decade later, people rose up, demanding freedom, rights, end of corruption. He met them with bullets, and then it spiraled into this multi-layered conflict with external players, with jihadists like Islamic State rising up, and capturing, large chunks of territory, and then the whole conflict kind of like going into a whole different direction, with Iran heavily involved on his side and Russia involved on his side. So I think people are still inside Syria coming to grips, and let's remember also the huge, humanitarian toll of all of this. I mean, at least anywhere from 300,000 to 500,000 people killed. Half the population, I mean, the population of Syria is 24 million. Half of that is either internally or externally displaced. And you're talking about at least 100,000 people who have been forcibly disappeared by the regime. And people don't know if their loved ones dead or alive as the prisons open up. I mean, they're trying to find, whether their loved ones are still alive. So I think we need to keep that in mind. But obviously, yes, focus on what comes next.
Sam, I hear what you're saying about the violence, and it has been grotesque. But is the Middle East more stable with Assad or without Assad?
Well, that's an excellent question. I mean, up until this point, or I would even go even further back. I mean, from the moment like his dad took over and the last war between Israel and Syria, 1973. I mean, remember that war. And then Kissinger flew over, at the time, the Secretary of State at the time under the Nixon administration. And he spent months negotiating with the father, Hafez. And you have this, pretty much agreement in place that we will leave you alone to run Syria however you see it fit, as long as you do not attack Israel again, and as long as you make sure, extremists or Islamists don't come to power the same way they took over power in Iran. So that was kind of the arrangement. And even when the son took over, I mean, Tony Blair was at the time, the former UK Prime Minister was among the first leaders to fly to Damascus to meet with Assad and his British-born wife, Asma al-Assad. And everybody was hoping that he would be the so-called reformer. So let's remember that.
Sam, thanks for the catch-up. Thanks for updating us. we'll keep up to date with what you're thinking in terms of your thoughts on how this evolves from here. Bloomberg's Sam Dagger joining us on what is happening in and around Syria. What else do you need to know this Monday morning? The advertising giant Omnicom is reportedly in advanced talks to buy its US rival Interpublic in a deal that could catapult the combined entity to the top spot globally. The Wall Street Journal says the all-stock transaction would value Interpublic at between $13 and $14 billion. Watch European rivals WPP and Publicis at the open. The World Health Organization is investigating a mysterious illness in the Democratic Republic of Congo. The WHO says over 400 reported cases and 31 deaths have so far been linked to the illness labelled Disease X. The flu-like illness is affecting mostly children under 5, with all the severe cases involving individuals with severe malnutrition. And the New York police have released images of the suspected gunman who killed health insurance executive Brian Thompson. One of the images shows the masked man in a taxi after the shooting. Investigators say the suspect hailed a cab on the Upper West Side of Manhattan soon after the attack, heading to a bus station to leave the city.
Coming up on the programme, we will head to Abu Dhabi. Finance Week is taking place there for a conversation with BNY's chairman of International. Plus, CVC is reportedly in talks to buy the German firm CompuGroup. We'll check on that story as it develops at the Open. Up next, we will check on how markets are gearing up for the week ahead, with the ECB decision being overshadowed perhaps by geopolitical turmoil. We'll get a focus on markets once again. If you have any questions, if you want to get involved in any of our guest conversations, be they geopolitical or markets in nature, or both, IB plus BBTV Go. That is the function to use this Monday morning on your Bloomberg terminal. This is Bloomberg.
"19 minutes past the hour. The US President-elect Donald Trump says he has no plans to replace Fed Chair Jerome Powell when he returns to the White House. Trump spoke in an interview on NBC's Meet the Press yesterday.
I don't see it, but I think if I told him to, he would. But if I asked him to, he probably wouldn't. But if I told him to, he would.
You don't have plans to do that right now?
No, I don't.
We'll talk about that a little more in a moment. Busy week coming up. CPI data obviously on deck, and also the ECB. Let's pull it all together with what we can anticipate with Bloomberg's Valerie Totel.
Guy, that was Trump's first TV interview since he won the election. No new wild cards there. Yes, he was tough on the border. Yes, he was tough on tariffs. But he didn't necessarily throw us any new wild cards, and we're treading water when it comes to U.S. assets. We have those S&P futures hovering near all-time highs. The Bloomberg Dollar Index slightly stronger on the day, but the big risk event for U.S. assets comes on Wednesday with the U.S. CPI report. We're expected to see a 0.3 month-on-month tick-up in both the headline CPI and the core CPI. Those are going to take us a bit farther away from the Fed's 2% target. But many out there think that it was Friday's payroll report that mostly cemented that cut from the Fed next week. Any hot CPI print maybe will change the narrative for the Fed moving into 2025. But we do have many central banks on deck this week, starting with Tuesday with the RBA, expected to stay on hold. But then on Wednesday, we get the Bank of Canada. They're expected to go for their second jumbo 50 basis point cut in a row after an unexpected rise in their unemployment rate on Friday. On Thursday, we have the European Central Bank's meeting. We have the ECB and the Swiss National Bank. Both the risks there are a bigger cut than what's priced in. The SNB is expected to cut 25 basis points, but it was only a month ago that we heard from them that negative rates are in their toolbox. And then the ECB on Thursday also releasing their macroeconomic projections alongside their rate decision. The risk there is that they intend to make a big statement with both.
Valerie, thank you very much indeed. Let's get more on what we could see moving markets this week. Paul Donovan, Chief Economist, UBS Global Wealth Management, joining us around the table. Morning, Paul.
Good morning.
How hot would CPI have to be this week for the Fed not to cut by 25 basis points?
I think it's difficult to say because it depends on the composition. So much of CPI today is just this fantasy price, the non-existent price of owner's equivalent rent. That's what's really been propping things up. If you look at the underlying levels, if you look at market-determined prices, if you look at HICP, measuring it the same way that Europe does, you end up with a number on inflation which is below 2%, and actually quite comfortably below 2%. So we don't really have the underlying inflation pressures. So I think if you get something which is just a weirdness in the owner's equivalent rent calculation, the Fed should just say, well, you know what, that's just a nonsense number. It's not changing people's living standards, and focus in on the numbers that actually matter.
So 25 bips is baked in for December. The market then seems to be seeing a pause coming at the beginning of the next year, and a pause that could last for quite some time. Is that the end of the cycle? And if that is the end of the cutting cycle, should I start thinking about hikes, and when should I start thinking about them?
I think it's far too soon to be thinking about hikes under a sort of a fairly benign tariff scenario from the incoming administration. Essentially, what the Fed has been doing so far is following inflation down. So we've had inflation fall, give or take 1 percentage point this year. The Fed's only cut 75 basis points. That's why we need the December cut. They're basically catching up. They were late to start. They messed up in the September, but they're catching up now. So we've got that. As we go through next year, I think inflation probably still does come down further. And that's because the owner's equivalent rent nonsense will start to come back to a more realistic level. We will start then to see the Fed tracking that lower. The question then is how much damage to inflation does the tax on consumers via tariffs do?
OK. Paul, I interrupt this broadcast to bring you news from China. We've had headlines coming through from the Politburo. So the Politburo meeting running before the Central Work Council meeting in the middle of the week. And we've got a couple of red headlines coming through from it, saying that China's fiscal policy will be more proactive next year. Also saying that shifts in monetary policy stance for the first time since 2011. I'm not looking for detail on that. Stepping up their extraordinary counter-cyclical adjustment maybe is what they are referring to there. But on the fiscal side, things seem a little clearer. So they're saying they're going to be more proactive next year, this ahead of a Trump administration where one assumes they're under a lot of pressure from multiple places to do more to stimulate domestic demand.
Yes, and I think that the Trump administration provides a convenient excuse because, of course, what we've got as a problem in China is that domestic demand isn't particularly weak because of the cost of credit or anything like that. It's weak because people are nervous about the future. There is insecurity. You've got quite high youth unemployment. That means anyone who's got, a son or a daughter who's just graduated from college is going to be very aware of the problems of finding work. It adds nervousness. So you need proper fiscal stimulus, which we have not had yet. Now, what I think the Trump administration does is, with tariffs, provide a convenient scapegoat. It's not our policies that are wrong, it's the attack of the Americans that we need to respond to. So it's a very convenient way of framing a fiscal policy stimulus.
OK, that's the fiscal side. On the monetary side, they're saying China monetary policy to be moderately loose. How does that fit with your expectations? I mean, we've been expecting more triple-R cuts. Is that it, or something more?
So the problem here is I don't think this does very much. Because, again, people aren't sitting at home thinking, oh, well, the cost of credit's too high, we'd better not go out and spend money. People are sitting at home thinking, I may not have a job next month. And that's a very, very different set of circumstances. So, yes, by reducing interest rates, you do give indebted people back a bit more cash flow. That's helpful. But it's not the conviction that you're going to get on the fiscal policy side. So I think this is fairly marginal on the monetary policy side. It's a quick fix. It's a signal of an intention to do more in the future. But actually, it's the fiscal policy that we need to see.
Very quickly, Paul, let's continue our tour of the world and talk about Europe for a moment. You talked about using Trump as kind of this almost license to ease. You're seeing that in France as well. This is something that came up multiple times in the vote of no confidence against Michel Barnier. If we have an expectation of a new budget that could increase inflation, the cost of living for a lot of French citizens, how does the ECB address that?
Well, it's only one province of the greater Euro empire, so I don't think they would necessarily get overly concerned with that. You've got general disinflation pressures. And anyway, I think we've got to remember we're not talking necessarily about fiscal stimulus coming through from France. It's a failure to address the fiscal problem. So it is an absence of tightening rather than an easing that we're looking at as far as France is concerned.
What's that bar, though? What is that bar where the ECB does need to get concerned?
With France as a single area, I think that bar is very high indeed. The ECB exists to look at inflation in Europe as a whole. You've got disinflation pressures established even in economies that are performing quite strongly, like Spain. The inflation picture is very benign. So I don't think you're necessarily going to see the ECB panicked about a peculiarity in one region of the greater Euro area.
We'll certainly hear from them later this week. Paul Donovan, Chief Economist at UBS Global Wealth Management, joining us this morning around the table. We thank you so much. Coming up on the program, we go back to our top story. Syrians celebrating the fall of Bashar Al-Assad. We look at the country's next chapter and which regional powers stand to lose out. That conversation next. This is Bloomberg. 30 minutes from the start of the opening trade. When you look at the futures picture, you did see it just a little bit mixed. 30 minutes ago, we did see some underperformance in the Eurostoxx 50 futures relative to the FTSE 100. You are seeing the same dynamic here as well. Futures at the moment kind of flat, pairing some of those losses, maybe in line with the tick higher you're seeing in S&P futures as well. But net, not a ton of movement. We'll see if that changes going into the opening trade. The bond market might be slightly more interesting, maybe waiting for a little bit more direction from the ECB here, seeing bids across the curve, across the continent, I should say, in Germany, France, and Italy, Anna.
Yes, and interesting that we have seen, it doesn't look like much movement on stocks, does it? But from slightly negative, we are now a bit more mixed, and maybe that is to do with some of the headlines we've had out of China. So we'll focus in on those for a moment. China's fiscal policy to be more proactive next year, this according to the Politburo, which has been meeting ahead of the Work Council that takes place Wednesday this week. They're also talking about China's monetary policy to be moderately loose, so we'll see how that fits with people's expectations. They're talking about lifting investment returns and expanding domestic demand. They're also giving us a whole host of details as to how they're going to go about this, but to be talking about expanding domestic demand, in all aspects. As I say, we are seeing a little bit of a turnaround in sentiment in Europe heading into the first trading day of the week as a result of this, but not a huge amount. We maybe have a sense of having been here before. We're waiting for more detail. Let's move on. Abu Dhabi Finance Week is kicking off today. Bloomberg's Jumana Basecha joins us live from the event. Jumana.
Hi, ladies. Yeah, good to see you. Well, it's been quite busy at Abu Dhabi Finance Week, speaking to loads of industry professionals on the sidelines. I'm very happy to say that one joins me right now, Hani, Kablawi, the chairman of International for BNY. Good to have you here.
Thank you very much. Great to be back in Abu Dhabi in weather like this, having just arrived here from London.
I'm sure, yes. Weather is certainly a plus over here. But look, let's talk about markets. It feels as though things have really been in a state of euphoria. Stock markets up, tracking more than 30% this year, even more so another boom after the U.S. elections. What is your outlook going into 2025 on some of the market optimism that there is right now?
Yeah, look, Jumana, our analysts are calling roughly 5% up in the S&P 500 and roughly 5% up in 10-year bond yields next year. On balance, that probably favors investing in bonds, save for the risk of stagflation. So the one item that we do look at is in developed economies that are heavily debt burdened and dealing with a fiscal issue there. We do look at their ability to continue to service their debts over time, especially with a probably stickier, higher interest rate environment.
Yeah, it's funny because the debt backdrop is something that we flag from time to time. It's not a new phenomenon, and yet the overall levels of debt in the global economy keep rising. Of course, GDP is rising as well, but the pace at which countries are accumulating debt is faster than the pace at which they're growing. And do you think that this is going to actually pose a serious problem in the next few years, or is it just something we're going to have to keep on the back burner?
Well, I think it's a factor of a number of things in the short term: interest rates and interest rate levels and the ability of countries to continue to service that debt. And in the long term, what goes up must come down, and it comes down either by more fiscal responsibility, or you can grow your way out of a debt issue. But for growth, you need productivity gains. And with a backdrop of weak demographics in many countries, you probably have a backdrop that is not very conducive to long-term getting yourself out of a debt burden like that.
Yeah.
Maybe save for the U.S. The U.S. is looking okay from a productivity perspective. They still have the fiscal deficits. They still have the debt burden. But they are looking to invest increasingly in improving productivity. They have a demographic surplus, let's say, versus other countries. And so those are the factors that we look at. So
many people I've spoken to, actually since the U.S. elections, have been really excited about the prospect of more deal making and unlocking of M&A activity in the U.S. next year. Wearing your current hat, which is chairman of the international business, do you think there's going to be knock-on effects to the rest of the world if deal making picks up in the U.S.? Yeah,
it's interesting actually. Since the 2022 refocus of investors on the U.S., including U.S. investors, investors actually bringing in their investments back to the U.S. We do actually expect continued U.S. exceptionalism from an investment perspective into the Trump administration-led environment in the U.S. And we're seeing that play out in places like Europe, where the euro is down. Investment in Europe is following productivity and industrial a deficit in industrial strategy. The markets that look interesting for us and where I think there is an opportunity for growth markets, developing markets to bring capital back home. The markets that look good to us actually are the Middle East, Malaysia, Indonesia, India.
Yeah.
We do like what we see in other places as well. Japan is looking to take savings and mobilize them back into investments. And then places like Brazil and Mexico.
Yeah, it's really interesting that you say that, because there certainly appears to be a shift in thinking from some of the sovereign wealth funds out here in terms of just being capital providers. They're also wanting to incentivize asset managers to invest locally.
Yeah.
How does that affect what you do in the region?
Yeah, look, it's first of all, the backdrop that you described, Rumana, is a good backdrop. Frankly, the environment, and it's been a long-term environment that we've lived in, where U.S. consumers create deficits in the U.S. that get financed and funded by sovereign wealth funds in oil-producing and in manufacturing countries. That model might, over the next few years and decades, give way to an environment where local investment by growth markets produces more local consumption and reduces the dependence or the codependence of sovereign funds and the U.S. market effectively as a consumer of last resort and as an investment destination of last resort.
Yeah.
So I think this whole it's not bipolarity, but it's multipolarity of the world, right, is a very good thing.
Yeah.
Now, in terms of your question on impacts on business model, our business model is a global business model.
Yeah.
A lot of our growth actually comes from enabling global investors access global markets. It's part of that is accessing U.S. markets and U.S. investors accessing global markets, but much of it is actually around enabling Middle Eastern investors get into China. We are the provider of services here in Abu Dhabi to some of the leading asset managers and wealth funds in investing in global markets, not just in the U.S. So we see trends like that as being conducive and positive for our business model.
And certainly in the region, I mean, Abu Dhabi, the theme of Abu Dhabi Finance Week is the capital of capital.
Yep.
But it's certainly, I'm not sure how Riyadh feels about that. And I just wonder whether there is enough space in this part of the world for all of these financial centers to thrive. You talk about Dubai, you talk about Abu Dhabi, you talk about Riyadh.
Yeah, it's a really good question, actually. So I would say my understanding is that Abu Dhabi is establishing itself as more of a buy-side hub. You have a sell-side hub down the road in Dubai, and I think Dubai has done a very good job that way. I think Abu Dhabi has the wherewithal, the intent, the capital, the money, the investment spend, the ability to bring global talent into Abu Dhabi in order to invest regionally and domestically.
Yeah.
And we're certainly investing alongside it by upgrading our presence here to a branch, hiring talent here locally, bringing talent from New York, London, and Europe and elsewhere, and participating in that growth.
Well, that's a good place to leave it, especially given we are at Abu Dhabi Finance Week. Thank you so much for joining us.
Thank you.
That was Hani Kablawi, the chairman of International from BNY. Ladies.
Bloomberg's Jumana Bersachi joining us from Abu Dhabi Finance Week. We thank you so much for bringing us that interview. Let's go back to our top story out of the Middle East. Bashar Al-Assad has landed in Moscow after Islamist-led forces led a lightning advance through Syria, entering the capital on Saturday evening and ending more than half a century of his family's rule. Assad's toppling comes after more than a decade of war, 600,000 deaths, and the world's worst refugee crisis since World War II.
The fall of the regime is a fundamental act of justice. It's a moment of historic opportunity for the long-suffering people of Syria to build a better future for their proud country. It's also a moment of risk and uncertainty.
President Joe Biden there, of course, speaking on the situation. Let's get more by Fawaz Gerges, international relations professor at the London School of Economics and author of What Really Went Wrong, the West and the Failure of Democracy in the Middle East. Fawaz, a pleasure to have you on the program. Thank you so much for joining us this morning. Before we get into the dynamics of the Middle East, let's start where perhaps Biden has been speaking, and that, of course, is what the U.S. response might be to the developments we're seeing in Syria. President Biden already authorizing strikes in Syria, as my co-anchor Anna had mentioned. On the other hand, you're seeing Donald Trump, the president-elect of the United States, posting about not getting involved. Fawaz, walk us through the impact of what the United States does next in response to this toppling of Assad's regime.
The United States is conflicted on what's happening in Syria. On the one hand, they're happy that Assad is out for good. They're happy that what happened in Syria represents a major setback for Iran and for Russia, America's major rivals in the international system. On the other hand, they are anxious about the future, in particular since Hayat Tahrir al-Sham and Abu Muhammad al-Gulani, the leader of Hayat Tahrir al-Sham, it's a Salafi Sunni movement, are the most powerful faction within the opposition. And when President Biden talks about risks and uncertainties, he is basically concerned about Hayat Tahrir al-Sham establishing an Islamic Emirat in Syria, because Hayat Tahrir al-Sham is designated as a terrorist organization by the United States.
Yep.
And just in the past 24 hours, the United States carried out 75 attacks against ISIS cells inside Syria. The Americans are anxious about basically the resurgence of ISIS. President Trump doesn't care. President Trump actually wanted to pull out American forces from Syria. You have about 1,000 American troops in Syria. So with Trump, we might in fact see a change, radical change. He might order pulling out the remaining American soldiers in Syria and risks basically the well-being and the autonomy of the Kurdish forces who have been fighting with the United States for the past since 2011 against ISIS or the Islamic State or Daesh.
Professor, good morning. It's Guy. Does Syria as an entity survive? And if it does survive, is Syria more unstable post-Assad than it was pre-Assad, during Assad?
I think I have no clear-cut answer to you. Syria could go two ways. On the one way, Syria could really descend into all-out social, political, ethnic, and religious upheaval, similar to what has happened in Libya, in Yemen, and in other war-torn countries. On the other hand, Syria could really begin the process of social healing. It could begin the process of state building, nation building. If the rough coalition of opposition, which is led by Hayat Tahrir al-Sham, could really establish a transitional government, a diverse government, an inclusive government, a rational government, I think Syria could be on its way to begin to really overcome the huge challenges, broken economy, deep scars, ethnic, religious, and tribal tensions, geopolitical meddling in its own affairs, major challenges. I mean, I think we are blinded by the dust. It's too early to tell. We have to wait and see what the opposition, what the rebels do, how they establish a coalition government. And the worst case scenario for me is that if the rebels start fighting with each other about power and ambitions, then the situation could really easily deteriorate into all-out social, political, and ethnic upheaval.
So we're blinded by the dust, Fawaz. In terms of the very immediate risks, we're seeing headlines on the Bloomberg terminal suggesting that Israel has struck at Syria's chemical weapons as what it calls a preventative measure. The fact that Syria has chemical weapons, these we know have been famously used against Syrian people under the previous regime. This just one of the aspects of the very short-term danger, I suppose, that this instability must prompt in terms of the thinking from the international community.
It is a major challenge for the Syrian people. And in fact, I was really impressed that the opposition has made it very clear they will cooperate and coordinate with the international community regarding chemical weapons and other factories, arms factories inside Syria. They're fully aware of that. But with all due humility, this is the least of Syria's problems. Syria's problems, I mean, remember, it has had 5 decades of brutal rule by the Assad family, 24 years of Bashar al-Assad brutal autocratic rule, 13 years of civil war. 300,000 people have been killed. 500,000 people have been injured. 6 million refugees, the biggest refugee crisis in the world. Millions displaced people. The country, 80% of the Syrian people require humanitarian aid, according to the United Nations. The country is fragmented. There is no trust among the various communities. So I hope that the rebels, the opposition, the coalition, the rough coalition of the rebels realize, appreciate the enormity, the gravity of the challenges facing the opposition and begin the process of setting up a rational, inclusive, and diverse government to deal with the challenges facing Syria and the Syrian people.
Professor, as a final question to you, walk us through, just for a global audience, how much of this regime change and this kind of toppling of Assad's regime is a direct function of Iran and Russia fighting 2 separate wars? How much of that has led to this moment?
On it, to give you an example, to really, put my finger on the pulse of your question, Bashar al-Assad could not have survived without Russia's military intervention in Syria in 2015. So Russia's military intervention in 2015 was decisive in the war. It turned the tide of the war against the rebels. Bashar al-Assad could not have survived without Hezbollah and Iran military intervention inside Syria. And the reality is the Syrian army has been gutted in the past few years as a result of American sanctions, as a result of Russia and Iran and Hezbollah being preoccupied somewhere else. The Syrian army did not really have the will and the means to stand up and defend the Assad regime any longer. So yeah, you're absolutely correct. The fact that Russia and Iran and Hezbollah were out, in fact, it exposed the weakness, the fragility, the vulnerabilities of the Assad regime. The emperor was naked. Bashar al-Assad shown to be naked, and that's why he packed and left to exiles in Russia in the past 24 hours.
Professor, thank you very much indeed. Fawaz Gerges, International Relations Professor at the London School of Economics and author of What Really Went Wrong, the West and the Failure of Democracy in the Middle East. We'll continue to monitor what is happening in Syria. We need to, of course, keep you updated with what else is going on. China firmly in focus this morning. News coming out of this Politburo meeting talking about stabilising property and stock markets, talking about an ease in the monetary policy stance, vowing more fiscal spending. A little vague, though. We weren't really looking for details here, but a little vague maybe on exactly what that all means. Markets have been responding. As you can see, we've got a lift in the Hang Seng this morning, responding to these details. We'll see how Europe opens on the back of that as well. All of that is coming up. 11 minutes to go to the start of European trading. This is Bloomberg.
Welcome back. This is the opening trade. Let's get into a conversation in 3 minutes about these markets. We're joined by Bloomberg's executive editor for Asia Markets, Paul Dobson. And Paul, nice to have you with us because we've heard these headlines this morning from China. European futures popping higher, in particular in France, as a result of this. A commitment to further fiscal stimulus in all areas. How much of a game changer is this or not, Paul?
Yeah, good morning, Anna. It's certainly what the market had been hoping for and waiting for in terms of some signs of real policy deliverance here from the Chinese authorities. We remember we had that big run-up a month, 6 weeks ago, and then we started to lose a little bit of steam in China's markets because people were asking, well, is there going to be follow-through? Are we really going to see signs of stimulus? Now what we're hearing, a commitment to a looser monetary policy, fiscal support, efforts to prop up both the stock market and the housing market. That's what the market has been waiting for. All those boxes checked more or less, and then this sets the tone for the Central Economic Work Conference discussions, which will start pretty much straight afterwards, as we understand it. So the market will be wanting to see more follow through, more delivery, more details. But at the moment, we've got gains in the equities market, and particularly corporate bonds have been getting ready for this. We've seen some parts of that market yields falling for 20 days in a row. People liking it on the rate side, people liking it on the fiscal side as well. So double whammy there.
Paul, how sceptical are investors, though? We've got the talk. Do we have the walk?
I think that the market will certainly want to believe it and price in the good news. Certainly, there's been a great deal of reticence, but it's gotten to the point where it feels like, something really had to be delivered. We've had quite a lot of incremental measures along the ways, and now more of a package is what the market has been hoping for. It's hard, right? It's hard to know with certainty whether we will get that delivery and whether it will be enough. There's been a lot of disappointment. There's been a lot of false starts already in the market and a lot of investor disinterest as well. So not the entire market engaged. But if it does really catch wind, then it could start to gain a lot more traction and momentum because valuations are so low across the market.
Paul, we had a different Paul on the show earlier talking to us about the fact that this kind of idea of a Trump administration could give China license to ease further. Do you agree with that?
Trump administration could do all sorts of things. Who would want to be a forecaster in financial markets for next year, Kriti? It's going to be very difficult. I think what's really interesting is you're seeing more and more strategists putting out these notes saying, what are the curveballs? What could we get wrong? What could be the surprises next year? So everything's kind of out there. More rate cuts certainly possible. But on the other hand, people even talking about the US might need to tighten again in the second half of the year, depending on the inflation outlook. So it's very uncertain at the moment in terms of where we're going to get, where we're going to see, how it's going to kind of rebound across the rest of the markets as well. So people having to stick with their game plan for now, but there's going to be lots of uncertainty and wobbles along the way.
All right, Bloomberg Executive Editor for Asia Markets, Paul Dobson, joining us for those markets in 3 minutes. We thank you so much. In the meantime, we are minutes away from the opening trade across Europe. A real sentiment change, green on the screen when you look at the futures picture. Stick with us. This is Bloomberg.
Monday morning, good morning. Lots to talk about as we enter this new week. We're watching, obviously, geopolitics casting a long shadow over pretty much everything right now. We've also got CPI this week. You've got an ECB meeting this week. So how are we starting? This is the legacy out of Friday. Friday's session, gap lower, followed by a rally, finishing fairly sort of neutral at the end of the day as we priced in payrolls as well. France was the standout story on Friday. French equities flying as shorts were taken off as the market recalibrated. US markets in the afternoon session dipping a little bit, maybe providing actually not that much guidance, I don't think, first thing this morning. China may be a better story. Is the CAC move this morning, Kriti, do you think a continuation of Friday, or do you think it's given fresh impetus by this China story reading through into luxury?
Well, so interesting because going into this morning, you did see the narrative simply be that there would be a pullback in that France equity rally, and yet we're seeing it again, but for a different reason, Guy. You mentioned it's that China story that's really showing up, but the ripple effect is showing up in the Eurostock 50 futures, now outperforming, Anna, the FTSE 100, which is a dynamic we did not see just 30 minutes ago.
Yeah, absolutely. So we're keeping an eye on how that China story permeates into the European session. And as you point out, Guy, the French story might or might not be to do with that, and might also be to do with domestic dynamics. But we'll keep an eye on luxury stocks, whether they're in Paris or Milan or elsewhere. Advertisers could be in focus. We've seen an interesting reporting coming through from the Wall Street Journal that Omnicom and Interpublic over in the United States could merge. What does that mean for European advertisers? We'll watch Publicis, we'll watch WPP as a result of that talk, at least, of consolidation within the sector. Also, watch out for Banco BPM. Crédit Agricole is asking to increase its stake in Crédit Agricole, and in the meantime, it's increased it through derivatives. So we'll watch how that one trades, given UniCredit's intentions towards BPM, Guy.
Let's talk about the open this morning. How China influenced is it going to be, Anna? Here we go. Time for the opening trade. Let's show you some numbers and get an idea of what is going on here. Remember, Friday, CAC outperforms significantly. We start to see maybe a little bit more of a discerning market looking at individual names. This morning, we're out of the gates. We're up by 0.2% on the FTSE 100. Is there a China trade there into the mining stocks? Is this going to be an investment-led story? Is it going to be pulling in extra resources? That could be a boost for the FTSE 100, which now starts to maybe outperform the stock 600. We're up by 0.4% on the FTSE 100, but the CAC blasts through. We're up by 0.8% on that market as well. It outperforms outperforms the IBEX? Remember, some of the peripheral markets have done better recently. Do we start to see the CAC coming back? The FTSE 100's been a bit of an underperformer as well. You could argue it is up by 0.4%. So we are seeing some gains here. How do we kind of discern what is China-related, what is momentum out of last week related is going to be, I think, interesting this morning. There are some single stocks that we're going to be watching as well. Kriti, what's going on below the surface?
Well, the luxury story is indeed leading, Guy, and that to me does feel like a China story because remember, from the political front, we are still waiting for Michel Barnier's replacement, basically, to be named, or maybe him himself, if he does remember that caretaker. That's not necessarily a reason to buy French equities. The China story, absolutely maybe. So you are seeing your biggest index contributor to the upside being LVMH here, actually driving the entire stock 600 higher. Kering is up there as well. I'm seeing L'Oreal as one of the big upside movers as well. But Anna, to the downside, it kind of feels like Germany is underperforming a little bit of that tech theme that maybe was going to drive the rally, not so much this morning.
Yeah, and if you're looking for evidence of China's influence, then maybe we see it in the best performing sector, which is basic resources. Iron ore up by 1.4%, and that has picked up after we got those headlines coming through from China. So we see Anglo-American up by more than 2.4%. We see Antofagasta is higher, Glencore, a whole host of mining businesses doing pretty well, and often that can be, of course, a China-related theme. But it is consumer products and services, as you say, Kriti, the luxury space that's also leading us a little higher. Richemont up by 3.4% now. Kering, Burberry, Moncler. It does raise this interesting question, though, as to whether, is this just cyclical in China, waiting for this fiscal stimulus to come through? Is that enough? Is that going to be enough to set the ground, set the foundations for another pick-up in luxury spending, which benefits French businesses or not? Has something structurally changed?
Well, this is what we were discussing a little bit earlier on in the show. The old playbook is China stimulates, consumer gets a better feeling, goes out, goes shopping, buys French luxury, buys European luxury. Is that still the correct playbook? It's interesting. We were talking about this earlier on offline. Has the Chinese desire to buy European luxury changed as a result of the political dynamic in China? And are we dealing with the old playbook when we see a reaction like this?
Perhaps. Hasn't shown up in the numbers yet, in the bottom lines of the LVMH, et cetera, where they're perhaps shifting, in theory, away from China and maybe more towards America, if we're looking at that kind of mass consumption story as well, but potentially to their detriment. That's not a transition that happens very easily. So I could argue the opposite, in that maybe because that market share hasn't changed yet, therefore the playbook remains the same. It's a fair one, though.
I understand the American reaction. I can understand that ultimately the US consumer is potentially the stronger one right now. Maybe expectations around the luxury names are so low in China that maybe any kind of a stimulus should deliver some sort of upside narrative.
And just mentioning, because we had this in the show a little earlier on, media stocks also in focus, guys. So WPP up by 3.5%, Publicis up by 2.6%. All of this, on the back of that talk over the weekend about further M&A activity, consolidation within advertisers in the United States.
WPP is on this kind of slow transition. It's trying to kind of change a lot of things at the same time, but it's taking a bit of time to get that done. Does this basically drive a need to maybe move faster on that process? But it's interesting. Does this reignite consolidation within the space? Are Publicis and WPP consolidators or consolidatees? I'm not sure that's a word, but I think I just made it up.
Yeah, it is now.
We'll wait and see. But yeah, it's interesting to see that this is being taken positive for an all-stock deal in the States. It's quite interesting to see such a big reaction.
We kept waiting, I think, for the majority of this year for that capital markets activity to warm up, and it's finally showing up in a pretty big way. Let's bring in a little bit more expert analysis here around the opening trade. Marija Veitmane joins us this morning, head of equity research over at State Street Global Markets. Marija, a pleasure to have you on the program, as always. We've got a lot to go through with you, but let's go with maybe our top line this morning, which is that China read-through. You just heard our debate around the table talking about whether playing China via French luxury is the way to play China. What do you think?
Yeah, good morning. To be honest, I'm a little bit skeptical on China. I think we need to see really big structural reform. And what we've been seeing so far is a kind of drip feed of kind of moves in the right direction, but probably like little steps as opposed to kind of big structural reform. So what we know, the problem in China is obviously we have a huge property problem. We had huge lack of consumer confidence. So, I mean, giving a little bit of money to Chinese consumer, would they go out and spend if the consumer confidence is really on the floor, given the kind of political situation is kind of anti-ostentatious spending? I'm quite skeptical. I think that's probably a move to fade.
Well, I'm so glad you said move to fade, because my next question to you was going to be, is this something you just trade for kind of the short-term volatility, basically catch the spikes, and then ultimately, is that the vehicle you use then to trade this kind of stuff?
Yeah, no, potentially, because I mean, what we've been saying is that every time there is like some policy announcement, investors get excited. We see inflows into Chinese market. I mean, European luxury is a good play on it, and then there is very little follow through, and we still see like latest data in China. There is still, I mean, at best stabilizing. I mean, if you're very generous. So yeah, no, I think it's short-term move. You play, and then yeah, there is very little follow through.
OK, Maria, we hear that loud and clear. We've also heard loud and clear in the past from you your views on US tech, and you've liked US tech for a very long time. You've seen no alternative, perhaps, to the US and to some of those very profitable businesses that might benefit from tax cuts coming down the line. Is that still the view? Is there anything on the horizon that you can see that will shake your view on that?
Yeah, I think I'm very firmly into Team America. I mean, there are structural things, like we know that like margins and profitability in US are a lot higher than in Europe, in Asia. So those things are not going away. And I think it's to do with like how deep capital markets are and what are labor regulations and taxation policies and things like that. So that's there. And then we have a cyclical element. And we know, I mean, I don't need to tell you about US exceptionalism. So that is still there. And other countries really struggling. I mean, it's going from like economic stagnation to political uncertainties and things like that. So it's difficult to see why would investors move money out of US into other regions. Yes, valuation is expensive. Yes, positioning is crowded. But what is super interesting to me when I look at State Street custodial database, investors increased holdings in US this year. So despite all these concerns about kind of overextended position, people still putting money there. So that to me is kind of validation of this idea that there is kind of no really good alternatives.
Yeah, I mean, Maria, are you concerned at all that there might be complacency around a second Trump presidency? Yes, there's the positives for corporates around tax cuts and some of the other policies that could be positive for US business. But on the negative side, some people are concerned about what this means on immigration. That's played a big role in that US exceptional growth story and indeed inflation. And even President-elect Trump over the weekend not ruling out that this might push up prices for Americans.
Yeah, no, I mean, I hear a lot like those concerns, of course, but I mean, relatively speaking, it's still US-centric policy. So if you are making kind of relative portfolio recommendations, so buying US stocks over rest of the world still makes sense. In terms of kind of absolute preference, I mean, we know that Donald Trump judges his presidency by the strength of stock market. So I suspect there is some bias kind of going down that way. We know Fed is very concerned about trying to get ahead of business cycle and try to avoid recession and kind of focusing on like dual mandate and achieving soft landing. That's very different dynamic from what we see in other central banks, which are kind of maybe more reactive central banks. So again, I mean, I see quite a lot of reasons to prefer US to other markets.
Maria, good morning. It's Guy. Are you still holding lots of cash? What would persuade you to deploy that cash? And is that cash a downside protection risk for your US equity holdings?
Yeah, absolutely. I mean, I've been jokingly suggested that the best trade would be US tech and cash. So that perhaps is still the trade, is that you have like a lot of upside on US tech, as it like the fastest growing, the large cap quality seems that we are like playing. But I'm quite concerned about kind of the rest of the market, because profitability is really not there. All of the kind of earnings, I mean, globally or US is still very much coming from tech sector. So other part of the market are not performing as much as we would like to. So having that kind of cash buffer or like short duration or like the way you kind of express that kind of makes sense to me.
Maria, what would it take to get US equity markets lower? What would it take to get the S&P lower right now? Is a full-blown recession required? Fed rate hikes potentially required? I'm just trying to think of, those are two unrelated items, but what would it take to get US equities to go lower at this point on a significant and maybe sustained basis?
Yeah, no, that's a really good question. I think, there's a lot of strengths of U.S. market come from tech sector, and that's been really the kind of the engine of U.S. stock market. So I think if you can imagine a scenario where a tech sector really goes down consistently, very strict set of regulations and kind of breaking kind of those quasi-monopolies, that potentially would be something that really kind of sustainable underperformance.
But you don't see that happening. In terms of...
I don't see that happening in the short, medium terms. No.
OK, so therefore 2025 is another good year. 2025 is another year when equity markets in the United States continue to rally.
Yeah, no, that would be kind of our central view, that there are good reasons for U.S. market to continue going up, definitely.
So the market just this exceptionalism, this gap with the rest of the world grows wider next year. How far can it stretch?
It's an interesting question, because we had about 15 years of this gap between U.S. outperforming the rest of the market. I think 2022 was a short blip when it didn't happen. So, and I think that there are good fundamental reasons, right? So earnings in U.S. have been stronger than the rest of the market for 15 years. So it makes sense that U.S. stocks outperform the rest of the market. So it's not like completely irrational idea that U.S. stocks do better because they grow faster. So that makes sense to me.
Marija, when you talk about the growth factor, Guy and I talk a lot about simply this idea of whether the stock market can actually come down in the United States. And it kind of feels like we're talking about these recessionary risks as well. But even in the worst of times, don't capital flows just support the U.S. equity market in all states?
You have this kind of dollar smile idea, right? So dollar goes up in bad times and good times, and it's kind of struggle in the middle. I think there's a similar idea about U.S. market as well. So if there are big risk concerns, and at least on relative basis, U.S. stock market should be supported as investors pull capital back there. And the other really interesting observation I recently had is if you look at MSCI growth style and MSCI quality, 7 out of top 10 stocks overlap. So in a way, it's a quality market. So I don't know, you can construct an argument that your tech mega caps are actually quality stocks and safe stocks, and that's where you should seek solace if you're kind of concerned about drawdown and slowdowns.
Marija, can I ask you about M&A as a theme? It seems as if we've been waiting for a long time to get this M&A cycle kicking off again. Investment bankers talk tentatively about seeing early signs of that, and maybe even more so in the last few months. And again, some people saying under a second President Trump term, we might see more M&A. Is that something you're going to be playing?
I think... it's again. No doubt the investment bankers talk about M&A. That's their business, of course. To us, it's really about interest rates. So should interest rates come down substantially, that usually sparks big M&A waves. So it's less about regulation. It's more about capital and cost of capital. So those things need to happen. Right now, market is not pricing market is pricing normalizing policy. Market is not really pricing very loose policy, which usually spark big M&A activity. So I'm somewhat skeptical.
Great to catch up. Always appreciate it. Thank you very much indeed for joining us throughout this year. We look forward to seeing you next year. Marija Veitmane, Head of Equity Research at State Street Global Markets. Core 6 looks like this, dominated, you could argue, by what is happening with the luxury space. Look at LVMH up really quite nicely this morning on the back of the news we're getting out of China. Is that the right way to play this narrative? I think that's going to be a discussion that maybe runs a little bit as we watch what the news flow looks like around China and the deliverables. For interesting that Ferrari, reasonably stable this morning. ASML ticking a little bit lower. Nestle saying unchanged, which also makes me a little bit sceptical as to what is going on. But the story, it certainly seems, is LVMH.
And sticking with that, of course, I want to get more on the luxury theme as well, because you mentioned LVMH, but looking at the CAC and run, you're seeing others as well. You're seeing Kering, you're seeing Hermes, you're seeing L'Oreal, Anna, all get a little bit of a boost from this China story.
Yeah, absolutely. So we're seeing it play out in the luxury space in France and beyond. We're also seeing it play out in basic resources. So the best performing sector this morning is the basic resources sector, and we see that iron ore prices are now up by 1.8%. So no surprise there that adds up to some better performance from the likes of Glacier Glencore, Antofagasta, Anglo-American, Rio Tinto, all higher, and the whole sector up by just shy of 2%.
Omnicom and Interpublic get together, potentially. The Journal's got that story. It's an all-stock deal. It's having a ripple effect on our side of the Atlantic as well. The two big names out of our part of the world, wire and plastic products, WPP, as it's probably better known, tracking higher this morning. Publicis out of France, it's now a big arrival. Both stocks rising on the back of this. Does this spur maybe extra activity to turn these businesses around, particularly WPP, and push it along a little bit faster? The market certainly seems to like the narrative around this story this morning and is lifting these European stocks on the back of that all-stock deal in the United States.
So a deal in the United States, potentially a deal here as well in the private equity space that's caught my eye this morning. CVC set to be in talks with German software firm CompuGroup to potentially take it private. This is a company, a German software company, that's been under some pressure for quite some time. And that takeover bid, or at least the talk of it, seems to be moving those shares. CompuGroup was halted for volatility earlier. It looks like it's now higher by about 31%. And CVC is seeming to rise as well. It usually doesn't happen in a takeover deal, but this morning higher by about 0.8%. A starting potential offers price of €22 a share.
Let's turn back to the BPM story. Credit Agricole listing at stake. We've got a fight on our hands.
Yes.
It's going to be really interesting to see what happens around this one. So does Agricole want to hang on to it? Does it see it as being its future to maybe control this business going forward?
Yeah,
what does that mean for UniCredit?
And it seems to be taking a line out of the UniCredit playbook in terms of how it gets hold of these assets, because it's going after it with derivatives in the short term. So with derivatives, it's taken its stake up to 15%. It's actually seeking to take its stake proper, if you like, over 10%. So it's seeking permission to do that. But in the interim, it's done it with derivatives, and it's going to ask to be able to go up to 19.99%. And of course, we know that UniCredit wants this asset too.
In some ways, you could argue this is a way of driving an even better deal. So do you just roll over straight away and go...
Because you're an existing shareholder,
You're an existing
aren't you?
shareholder. Do you want to buy my shareholding at this price? Maybe the answer is, no, I don't want to buy it at that price. Cool, I'm going to take an even bigger stake, and I'm going to make it even more difficult for you to take this business over, and therefore you are going to have to maybe come harder with a better deal for me if you are UniCredit? Or is it, you know what, actually we think this is a good business going forward and actually we'd like to stay involved?
Well, you know what I thought was interesting was that Reuters reporting that Italy has actually approved this. They've approved this Credit Agricole stake when they haven't approved the UniCredit. And I think that's such a turnaround from that kind of domestication, isolation kind of story that we were talking about with Commerce.
Governments don't like to be surprised, seems to be the story at the moment. If you come at us with a surprise, then our initial reaction is, whoa, back off a little bit. If you come at us with a deal that's kind of that is incremental and we understand, then maybe you get a better reaction. You can argue maybe Agricole's in that position. We've already got a stake. We'd like to maybe increase that stake.
Yeah.
You know us. We already understand this relationship. I suspect they know UniCredit as well. But that maybe is what seems to be coming out both in Germany and Italy.
Maybe there is something in the art of some of these deals. Coming up on the programme then, we'll turn our attention back to China. We've had a lot of news flow out of China this morning. China vowing more support. Luxury stocks and the Hang Seng cheer. Basic resource stocks cheering. We'll cross to Beijing to get the latest. Just how significant is this news that we've had out of the Politburo ahead of the Work Council meeting? This is Bloomberg. Welcome back to the opening trade. We are 22 minutes into what is turning out to be a very eventful session here for European stocks. We're up across the board. Stock 600 up by 0.3%. And it seems that basic resources and luxury stocks are getting a boost from some of the news flow we've seen coming through from China. China's top leaders are planning to loosen monetary policy and increase fiscal spending in 2025 to prepare for a potential second trade war with the United States. Joining us now for more is Bloomberg's senior executive editor for the Greater China region, John Yu. John, very nice to have you with us. Last week, I was asking myself, you know, if I were involved in Chinese policy making, would I be doing this fiscal stimulus now before I see what President-elect Trump has in mind, or would I be waiting to see the details of his plan? Well, it seems that China wants to do this now. How significant is this announcement today, John?
I think it's quite significant. I think this is the clearest signal yet that the leadership has given here in China that they're ready and willing to do more to support this economy. The language that they used to describe monetary policy, saying that it would be moderately loose going into 2025, that's the first change we've had in about 14 years. And so the last time that it was described, monetary policy was described as moderately loose, was right in the aftermath of the financial crisis in 2008. So you get a sense of what the leadership sees before it.
John, is this more talk or is this walk? Is this just kind of, we're going to do this and ultimately investors can be disappointed? Or should I take this as a certainty that this is going to be delivered upon?
I think we should take this as the opening of the gates to more stimulus. That once the Politburo has said this, the Politburo is made up of the 24 most powerful politicians in China. So this is the political leadership saying to the technocrats, to the central bank, to the finance ministry, you should now go out and do more. We should expect more.
But John, can you explain just to our global audience who maybe isn't following the story, to your point, this has been several iterations of that fiscal support. Why is this time different? What are they doing that's different that may stick?
So we've seen lots of things done sort of in a gradual way, nothing over the top, nothing, as people were saying, the markets wanted to see a big bazooka moment from China. We have not gotten that. This seems to show that the leadership has really had a mindset change. I think that has happened because the data that we've seen since the stimulus that was launched at the end of September going into October, that has not had the outstanding pronounced effect that I think the leadership was hoping for. I think that's why we are getting more now.
John, and the way that this plays out in Europe, I mean, for many years, good news out of China has meant you buy basic resource stocks in Europe and you buy luxury goods manufacturers in Europe because you predict better things for the housing market and the Chinese consumer will go out and buy more European luxury products. On the latter of those, is that still the case? We were having a conversation about whether the image of European luxury in China has changed because of geopolitical tensions. Would we expect this to be the same this time around?
I would expect that if Chinese consumers get more money to spend, they will go out and buy LVMH. They will go out and buy Gucci. They will go out and buy those products. They still hold a lot of cachet. Those companies are still spending a significant amount in terms of marketing. What has happened in terms of slowing growth in terms of luxury spending here in China is the property bust, the stock market being in the doldrums, people feeling poor, they are holding back on their spending. If what the government is doing now or is signal it's going to do, if that can resolve that situation, I would expect a return in spending.
Going to leave it there. Senior Executive Editor for Greater China region, John Liu, thank you very much indeed. Coming up, what are we going to be talking about? Small caps. Are they going to continue to outperform in 2025? JP Morgan strategists think so. We say small caps. European small caps or US small caps? Because European small caps, much less so.
He's got a global view in his notes, but obviously it seems like there are different regional stories there, Kriti.
Yeah, how much of it is a political trade, how much of it is a momentum trade, or even an interest rate story from the ECB?
Well, it's just an economy trade, isn't it? The US economy has greater momentum. Small caps tend to do better when an economy is doing better. European economy not doing very well, therefore small caps underperforming. Is it as simple as that? And does that continue to put money into the United States? Anyway, we're going to find out next. Lovely sunrise this morning. This is
This is the opening trade. We're at 30 minutes into today's session. Seeing green on the screen across the European stock market. Perhaps paring back some of the gains we saw earlier. Remember, we did get those China headlines. It boosted a lot of the stocks. And we're seeing a lot of it driven by France and the French luxury story as well, not to mention basic resources in the UK. Now maybe simmering down just a little bit, Anna.
Yeah, let's talk about the difference between small and larger businesses, shall we? JP Morgan strategists say that small and mid-cap stocks have the potential to deliver double-digit gains next year under a best-case scenario, although, quote, a lot can go wrong. Joining us now is their global head of small and mid-cap strategy, Eduardo Lecubarri, obviously hoping that things don't go wrong. Eduardo, thank you very much for joining us. So your expectations then for small and mid-caps, you say that they will go on to outperform next year. Is this a Trump trade or does this predate the Trump trade?
So I think, Anna, Trump definitely is a catalyst for small mid-caps to continue to outperform. I think it's important to notice that it's already kind of happened in the last 12 months. So small mid-caps underperformed large in 22, in 23. But then November of 23 to here, they've stopped underperforming. And I think Trump can definitely mean a continued of strength. because what Trump does is basically he has ignited a preference for domestic versus international exposure, and small mid-caps are more domestic.
OK, so sticking with the US, this is interesting because a lot of the conversations we have about US stocks has been around the big tech names, of course, the likes of NVIDIA and all of the other large Magnificent Seven, and a lot of the broadening out conversation then takes you to this small and mid-cap trade. So this has a lot further to run then. Under Trump, we see a lot more broadening out of US trade, you think?
I think so. So it's interesting because the last 3 years, I think the best way to describe it is what has happened is a temporary underperformance of small mid-caps for reasons that are temporary, but that the investment community has chosen to read as a new reality, right? And so what you're looking at here is investors having put a lot of hopes on large caps becoming this better asset class in a way where now 150 of the S&P 500 companies are trading on a PE above 35 times. You have things like Walmart on a trailing PE of 44 times, right? And I think one has to question that. So from here on, I think what you're going to see is that the reasons that small mid-caps have been penalized, i.e. in the last 2 years they had weaker earnings growth, those reasons that were completely temporary, it was, interest rates going higher in companies that have more floating debt and wage inflation being high in companies that are more labor intensive. All of that is behind us. And from here on, you're going to see the rewards of what you've always seen in the small mid-caps, which is better growth, more thinly covered, M&A, everything else.
In the US, this kind of makes sense. The economy's doing great. So therefore, small caps, mid-caps, maybe have a catch-up. Here in Europe, the economy doesn't feel so great. So why should European small and mid-caps catch up?
Well, you have to look at the nature of a mid versus large. And there are a lot of reasons why historically they've done better than large cap in terms of returns. And those reasons are still true today. So these are smaller businesses earlier on in their stage of development, and therefore they produce higher growth, regardless of what the overall economy is doing. That was the case historically. It is the case today. These are businesses that sometimes get taken out. In Europe, 5% of all the small mid-caps get taken out in M&A deals every year. The average premium is 30%. If you do the math, that's 1.5% of alpha versus large just from M&A, right? And then you have IPOs. Like 99% of all IPOs, which is new businesses, new industries, is all SMID. So all those drivers of growth are still there.
But we haven't seen much M&A and we haven't seen many IPOs.
Well, that's an interesting concept because that is definitely a consensus view. But when you look at the numbers, it's not really true. The biggest IPO year was 2021, right? And if you look at M&A, since 2010, it's been exactly the same year after year. It's been around 100 small mid-caps in Europe taken out every year for about a decade. Okay. So this perception that IPOs are not happening is perception. And this perception that M&A is not happening is perception. In fact, this year, number of M&A deals are up versus last year. I think there's a very good chance to think that 2025 is going to see M&A, number of deals in M&A just shoot up for all kinds of reasons.
But isn't 2021's outperformance on that front just a function of the capital markets being very, very closed in 2020? So it just kind of led to this excess of 2021? Isn't that kind of the reason for their outperformance? It wasn't necessarily a fundamental story, was it?
So IPOs tend to go with the market, right? So they peak when the market peaks and they come down after that and so on. 2021 was a peak of the market and it was a peak of IPOs, but not in any way that was different from what we saw, for example, in 2007, in 2000. It's just that when you put it all in a long chart, you realize that globally, number of IPOs in small mid-caps, they were bigger in 21 than in 2007 than in 2000. So you always have these peaks and troughs along with the equity market, but they haven't gotten smaller, they've gotten bigger. So IPOs are happening.
Let's come back to where we started the conversation, which was on the fundamentals behind small caps. You mentioned that there might be a Trump trade about there as well. But don't small caps trade very closely to your biggest caps, which brings me to, is the small cap trade ultimately just a momentum trade as opposed to one that is maybe driven by Fed cuts, Trump policy, et cetera?
So historically, you're right, Kriti, SMID is a bit of a beta play, right? So if the market goes up, they go up more. If the market comes down, they tend to come down a little bit more. What's interesting in terms of what we're living through at this juncture is there has been 2 times when that hasn't happened, right? When large caps outperform on the way up. That was the tech bubble and the situation we're living in today. And in the tech bubble, when that bubble burst and the stock market came down, it wasn't small mid-caps that underperformed. It was large caps that came down more. What went up came down. And there is a very good chance that you see that here. So now, small mid-caps is not just a beta play, but you are sitting here in a situation that is completely abnormal, where it's mid-caps that didn't benefit on the way up, and where, you know, the valuations, the fundamentals, the sentiment around it is all pointing to, I think, what is a 3-year story of outperformance from here on.
Eduardo, are there other geographies that we should be talking about when it comes to the small and mid-cap story? I'm thinking, we had a lot of news out of China this morning about stimulus in the Chinese economy. We've had a lot of news over the past week from South Korea, and colleagues writing about how the Kosdaq is underperforming the Kospi, and that is perhaps a sign that people's expectations for the economy domestically are really weak. Are there other geographies that stand out to you as worth mentioning?
So, Anna, I think when you think about geographies in the world, and in line a bit with what Kriti was saying, you have a situation today that is different in developed markets and emerging, right? In developed markets, you've seen SMID underperforming large over the last 3 years by an order of magnitude more than ever. So there is that kind of valuation story. And in emerging markets, that simply hasn't happened. And so there is, in one end, the underperformance and the value, and on the other end, what Kriti was saying, this is a beta play to the economy. Where is the economy growing? Well, you have more than 2% real GDP growth in the US, and you have 0.8% in Europe, to give you an example, right? So the best case is where you find that underperformance and you find that economic growth, you have to look at the US, you have to look at Japan, and you have to be short Asia, and you have to be short Europe, I'm afraid.
Do you have to be short Europe even in the face of interest rate cuts that might accelerate out of the ECB?
So it's a good point. You have to short Europe on a relative to basis. It is true that in Europe is going to benefit, or you should be benefiting from a real interest rate that has gone from 4 to 3.25, and let's see where it ends. But at the same time, the real economic, real GDP growth last year was 0.8, and our economics team expectations for this year is 0.8. So the growth isn't here yet. But Europe is a big part of the world, and there is Europe, and then there is Europe. So, for example, within Europe, there is the Nordics. And in the Nordics, your average small mid-cap after 2 years of underperformance is offering a 7% average free cash flow yield, which looks quite interesting. So I think there is definitely opportunities. Also think about this, 40% of small mid-caps across Europe, in the UK and in the continent, 40% are down more than 40% from the highs of 2022. There is tremendous opportunity at the stock level, right?
Going to leave it there. Really interesting. Eduardo, thank you very much indeed. Eduardo Lecubarri, Global Head of Small and Mid-Cap Equity Strategy, joining us from JP Morgan. So Volkswagen and its labour unions are entering the 4th round of talks, basically to try and sort out exactly what's going to happen next with the footprint that VW has, particularly in Germany. We've got lines coming out of Wolfsburg now from the workers talking about the fact that they are ready for more warning strikes. They're warning about more warning strikes, effectively, as we come towards this latest round of talks. How this ultimately gets resolved, are we going to move from warning strikes to more significant walkouts? We will wait and watch. But this discussion continues, and it's a struggle to get to some sort of solution at the moment. As I say, the 4th round of talks now between management and the union. We'll turn back to geopolitics next. Syrian celebrating the fall of Bashar Al-Assad. We're going to look at what the country's next chapter looks like. Which regional powers stand to lose out as well? We're watching what is happening with Russia and Iran. Does Turkey come out as the winner in all of this? We'll discuss that next. This is Bloomberg.
Welcome back to the opening trade. We're about 44 minutes, if you will, into today's session. Seeing green on the screen, perhaps not with as much force as we opened these markets, but you are certainly seeing a boost. A lot of this coming from the headlines out of China. This idea of stimulus perhaps boosting French assets at a time when we're still waiting for that political overhang, a little bit more clarity on who Emmanuel Macron is going to be choosing as his new prime minister, caretaker prime minister, if you will, certainly. But for now, green on the screen. Let's go back to our top story, though, and that, of course, coming out of the Middle East. Bashar Al-Assad has landed in Moscow after Islamist-led forces led a lightning advance through Syria, entering the capital on Saturday evening and ending more than half a century of his family's rule. Assad's toppling comes after more than a decade of war, 600,000 deaths, and the world's worst refugee crisis since World War II. We're joined now by Bloomberg's Patrick Seitz, joining us this morning from Istanbul. Patrick, From your vantage point, walk us through how this is being interpreted in Turkey and in some of the kind of bordering states. How bad is this for the people of Syria?
I think many Syrians will be celebrating, obviously, the events over the weekend. Whether or not that means they can return to their homes and at what point they can do that, I think remains to be seen. That will depend on things like whether HTS, this main leading rebel group, lives up to the kind of message of tolerance that it's been preaching on the way to Damascus. There's also, individual security incidents like last night we saw in Damascus, explosions late overnight, showing that, while the takeover of power has happened in the heart of the state, that doesn't necessarily mean that clashes are over. So I think anxious optimism among Syrians, good news, but not the end of the story by any means.
Patrick, can I ask you about the rebels and the various factions within that? I mean, HTS gets a lot of the headlines. There's plenty of coverage of others, SDF, SNA, a host of other rebel groups. Is HTS likely to be in a position of power in Syria? There are others waiting in the wings, no doubt, to challenge them. I understand they've been united up to this point by their dislike of former President Assad, but now he's gone.
Yeah, that's right. I mean, I think the way in which they've come to power so quickly and the sort of military, diplomatic to an extent, prowess that they've shown on the way is definitely going to give them an upper hand in the sort of talks that go towards forming a new government in Syria. But you're very right, they're not the only ones on the scene. I think the other areas to watch should be the north of the country, because, HTS has taken over Damascus, but Assad, from whom they've taken over, wasn't in control of the whole country anyway. So in the north, you've got other Turkish-backed factions. You've got the US-backed Kurds as well. I think that those are going to be the other key groups to watch now, both backed by big powers with big interests still in the region. And it's not clear how they're going to get on, cooperate with, or clash with even HTS from Damascus.
The Israelis have moved in to parts of Syria. We haven't seen this since the 70s, 73. What's the objective here? How worried will the Israelis be about what these new groups will mean and whether or not they take a more bellicose attitude towards Israel? Is that the fear here, and is that what maybe the Israelis are trying to preempt?
Yeah, I think it shows to an extent that they're obviously worried about a security threat from HTS. It's worth remembering, of course, that group has its roots in Al-Qaeda. I don't think there was a particular imminent threat to Israel at this point, so I have to assume it's a sort of a precautionary measure. And it basically extends that Israeli presence that was already there from the 60s, when they occupied and annexed the Golan Heights. So I think it shows them extending that security buffer, and as we've seen elsewhere in the region, in Lebanon, for example, they're trying to build an environment at home where their own citizens feel safe, just as they've done in northern Israel, going into Lebanon to do that for their Israeli citizens in the north. I think they're doing the same here in the Golan.
Yeah, they're describing it as a limited and temporary step. Patrick, thank you very much indeed. Bloomberg's Patrick Syke joining us out of Istanbul. Let's talk about what this all means for Europe. Bloomberg's Ollie Crook joins us now from Brussels ahead of a meeting with EU finance ministers. Talk to me about the reaction thus far out of Europe when it comes to the fall of the Assad regime and what this ultimately means for Europe. The Syrian story has had a meaningful impact in Europe over the last few years as a result of migrant flows.
Absolutely, guys. So I think it's going to be sort of fundamental from that migration perspective. In terms of the sort of initial reaction from the leaders here across Europe, I think it has been more or less ubiquitous. It is fairly optimistic with an even larger dose of concern and also caution. We heard from Kaja Kallas, the sort of EU foreign envoy who just took over the job, will be there for about 5 years, saying that the end of Assad's dictatorship is a positive and long-awaited development. It also shows the weakness of Assad's backers, Russia and Iran. This is similar rhetoric to what we heard from Biden over the weekend. A lot lot of the sort of Western countries wanting to take some credit in some way for undermining basically Russia and Iran's position in their ability to support the Assad regime. But that sort of caution comes in the form that though this has been a relatively sort of tidy shift of power, a lot of this will come down to Abu Mohammed al-Jolani, the leader of HTS, who obviously is a former sort of al-Qaeda, but who gave a very interesting interview to CNN a couple of days before basically marching into Damascus, saying that what he wants to do is bring sort of institutional rule back to Syria, away from individual leaders. He talked about protecting minority groups and talked about legal framework to preserve that. These are the sorts of things that many Western leaders will be very happy to hear. Whether or not it is true and to what degree he is capable of doing this, given all the fractured cells, as you have just been discussing, the focus for the Europeans will certainly be migration. I mean, you don't have to look any further than Germany. The Syrian civil war started in 2011. AfD, Alternative for Deutschland, the far-right anti-immigration party, was founded in 2013. And then 2015, Merkel let in more than 1 million refugees. And now, fast forward 2024, 2025, AfD holds about a fifth of the vote, 20% of the vote. And the Syrian population is still the number 3 population of all of these sort of groups within Germany. So really still a protagonist. The other side of that coin, however, is if you do get stability ultimately back in Syria, could some people go back there? These are all the things that are in play, and they will be in front of ministers who will be sort of affecting or appraising the effect of what's going to happen over the next few months.
Ollie, there's conflicting views coming out of the United States. Joe Biden authorizing strikes within Syria. Donald Trump posting about the fact that the United States shouldn't be involved. What is the European take there? Is there a European take there that aligns with one or the other?
Yeah, I think the Europeans are very reticent to have any sort of active military role in many of the sort of conflicts in the Middle East. But as you say, Joe Biden, having the strikes of dozens of different Islamic State sort of groups within Syria. Obviously, Donald Trump giving a fairly contrasting view, saying that the United States should have nothing to do with it. This is not our fight, he says. Let it play out. Do not get involved on Truth Social. But of course, there are other dimensions and other sort of players here. The Israelis who have now, have sent troops in for the very first time, admittedly, fairly sort of limitedly. Turkey is on the border, and there's, of course, the question in the form of Iran and Russia. And here the Europeans really do have a stake in them not exerting their influence. So I think that for right now, they're just going to probably follow the United States. The question is, what is the United States' position going to be? It seems like it's going to shift fairly quickly in the next 5 or 6 weeks.
All right. Thank you very much. Bloomberg's Oliver Crick, thanks for the update there. Let us focus in on what is ahead this week then. A quick look at the plan from here. We have plenty of events to focus on. A Eurogroup finance ministers meeting, including Rachel Reeves. Ollie will be around to tell us more about that. Tuesday, we'll linger on this for a moment in just a second. Women, Money and Power. That's an inaugural event coming to you from Bloomberg, and we will be there live. On Wednesday, we'll have a host of data. We'll have US inflation data. The Chinese policy meeting takes place. And on Thursday, an ECB rate decision. Let us circle back to that Bloomberg Women, Money and Power event that takes place tomorrow here in London. And let's bring into the conversation Adeline Diab, Director of Research and Chief ESG Strategist at Bloomberg Intelligence, who has just released the BI, Women Capital Report, so Bloomberg Intelligence Women Capital Report ahead of the event. Adeline, very nice to have you with us as we look ahead to our coverage tomorrow. So importantly, in your research, what's the big picture story around diversity and employing more women in your workforce? Does that diversity pay off?
So yes, the good news is that it does pay off. So companies with a greater number of women on their board have delivered 2 to 5% higher annual return in developed markets in 2018, and 2 to 6% lower volatility in emerging markets, in markets that are by nature more volatile, so helping weather those. So this suggests that, diversity as a quality signal that can help reinforce investment decisions, but also board conversations.
Walk us through what that means or what that looks like regionally. Are you seeing a divergence between, say, the States and Europe?
So, yes, the States have led the charge initially, but the EU has been more at the forefront for the past decade. In some countries, we see numbers exceeding 40%, and actually we could see even parity in Europe by 2030. But the stark difference remains more in emerging markets, but also in some G7 countries such as Japan. But regulations and shareholder activism should drive progress. So, for example, in Japan, there is a new target calling for 30% of executive female ratio by 2030. This suggests over 1,000 women director appointment opportunities over the coming 5 years. So this could be a game changer.
Do you think the Trump administration reverses some of the progress that's been made?
So there are risks there, obviously, and we have seen some companies start to retreat from their D&I programs, but many remains committed. And I would say, basically, whether you believe that diversity is a moral imperative or not, at the end of the day, the higher performance linked to higher diversity shows that it has a financial and a business case. So this should bolster D&I programs.
All right. Adeline Diab, Director of Research and Chief ESG Strategist over at Bloomberg Intelligence, joining us around the table to walk us through, of course, this very crucial issue and the divergences, the progress that's being made, and, of course, what 2025 and beyond looks like. Tomorrow, of course, the opening trade will be live from Bloomberg's inaugural Women, Money and Power event. We'll be speaking to Danielle Poli of Oaktree, Ann Walsh of Guggenheim, Joan Solitar of Blackstone, Ida Liu of Citi. And that's just a taste of the all-star guests that we have, and then, of course, the panelists at the event as well.
There's some fantastic panelists. We're just the starter.
Yeah, we're the opening act.
We're the opening act of this event, and then gets going throughout the rest of the day with some fantastic panels. So it's going to be really interesting to see exactly what their world looks like in a more Trump-driven environment.
Mm-hmm.
I suspect they're going to be talking more about the investment story and what they see in front of them. But at the fringes, does that change? Does the performance metric, therefore, you could argue, if the data are correct, change if we see Trump pushing back against this?
Yeah, perhaps. And certainly that'll get some airtime, but a lot of it will be dedicated to just hearing what these experts in their field think about global credit markets, about private equity, around wealth management. So there'll be plenty of those conversations, not least in our programme tomorrow. So we'll be joined by a host of, as you've been through, Kriti, a host of fantastic names, and highlighting some of the research that Bloomberg Intelligence has been doing on this front as well.
And that, of course, is something we're going to be keeping an eye on for tomorrow. But then we've got the rest of the week to think about as well. We've got plenty of data around the world.
Yeah.
China.
Is China less interesting midweek? Now, we've had all of this news already from China, or is there still more to come after Wednesday, Thursday?
It feels like this is something to come later. It doesn't. This feels like a 25 story rather than a 24 story. These are our intentions. We'll see what exactly is delivered upon at the beginning of next year. But CPI is coming up out of the United States. That's going to be fascinating. How dovish does Lagarde sound? I think is going to be fascinating as well. What data are we going to get from the ECB? There's lots coming up this week, but it does still feel like a geopolitical narrative at the moment.
Yeah, we're still on France watch. We're still going to see what Emmanuel Macron may or may not announce. On Friday, he promised that he would announce a caretaker prime minister in the next coming days. Of course, the fallout in the Middle East as well. In the meantime, markets in the green. We'll see if that sticks. That does it for the opening trade. The Pulse is up next. Stick with us. This is Bloomberg.